and a very warm welcome to all our participants today on this important topic of related party transactions, recording, accounting, disclosures. I hope we are able to cover the entire life cycle of related party transactions today. It's a complex topic, and there is a lot of discussion and debate happening in the industry around related party transaction disclosures, especially in the wake of industry standard prescribed by SEBI, which has gone live from 1st of September in particular. And we are really honored and privileged to have with us a very exciting panel today for deliberations on the topic of RPT. We are calling it RPT 2.0 version because truly this is seminal. The kind of changes that have been prescribed by the regulatory authorities in consultation with industry forums like CII, SOChem, FICCI. Really, I think now the disclosure standards have gone to the next level as far as related party transactions for listed entities are concerned. So, our first opening batsman and keynote speaker of the evening is a well-known person. He doesn't need any introduction, so to say. He has been one of our ardent supporters in the Excellencia series, has contributed a lot in the past as well. It's an honor and privilege to have you, sir, with us, Mr. Satish Shenoy, independent director, a very senior chartered accountant, cost accountant, company secretary, and of course, a commerce graduate with over 40 years of experience. He has specialized in internal audit, risk management, forensic accounting, ethics across PSUs, leading corporates, including HPCL, Onida, Lupin, Reliance Retail, L&T, and Aditya Birla Group. He had the privilege to lead the corporate audit services function for the entire group of L&T, excluding financial services, reporting directly to the chairman, Mr. A.F. Nayak. He later led corporate management audit at Aditya Birla Group, reporting to Mr. Kumaramangalam Birla. Wow, both are icons, and I think it would be a great experience for Mr. Shenoy to have interacted one-on-one with Mr. Nayak and Mr. Birla. He is a sought-after speaker, has anchored thought leadership initiatives like the CEO Speak series with the leaders from HDFC, HUL, Motilal, IFCA Labs, and others, as well as the series with 30 leading audit heads. I would request all the participants to please mute their mics so that we can do a proper introduction and start to the entire webinar. An active member of professional bodies such as IIA, ICAI, BCS, ACFE, Mr. Shenoy took voluntary retirement in April 2021. He now divides his time between writing, sports, mentoring, teaching underprivileged children, working in villages and traveling. He continues his corporate engagements as chairman of the audit committee on the boards of Indico Remedies and Cataline Limited. I would like to end his introduction on a personal note that he inspires me every day morning by sending in a fabulous message and making me part of his Reading Corner family. Sir, welcome to this RPT 2.0 amendment series and seminar as part of JHS Excellencia, and we are honored and privileged to have you. And with this, I would request Mr. Satish Shenoy to take center stage and give his opening remarks. After he's concluded, I will introduce my other colleague co-panelist here.
Thank you, Huzaifa. I think you've exceeded your brief in introducing me. I'm extremely happy to be here. In fact, this is the 6th time that you've taken the risk of making me a speaker in this wonderful learning fora. And hopefully, if I may add, not for the last time. I truly love to be here amongst you. I take this opportunity to thank Nikhil Kochar also and Huzaifa Kaka, who has been, true good friends in JHS amongst the many others that I have, kind of interacted and associated myself with. Welcome, Suresh ji. I think we had a nice 10-minute chat before this conversation. My old and good friend Himanshu Vasa, who is the Chalta Firta Encyclopedia in banking, and Tasnim, who is also a partner in JHS. So Huzaifa has given me a task of speaking only for 10 minutes. It's more an elevator pitch than actually speaking because we've got excellent speakers as we move along. So I'll restrict myself exactly to 10 minutes. I'll start by talking about RPT. I think it is in the last couple of years, it has been gaining a lot of significance in the corporate world. If you look about 25 years ago, in the pre-2000 time, uh, the oversight on RPT was by the company itself. There were no regulations, and corporates were expected to kind of do the regulations themselves. Then came the era of 2001-2 when the Enron came in. There was a misuse of RPT. The Sarbanes-Oxley regulations walked in. 2009, closer home, Satyam, Nirav Modi happened later. And there were many other financial scams, which I'm sure Suresh, Tasnim, and Himanshu will allude upon. Post 2000, lot of to 2010, lot of regulators, OECD, IASB, the Economic Offense Wing. There were so many regulators that really came in to tighten the regulations. And today, as we speak, the regulations keep happening on the RPT side. At a public event held recently, a senior official of SEBI expressed concerns over over related party transactions being the most frequent method by companies for diversion of funds. These observations came as no surprise, as past trends of mechanisms used by companies worldwide to commit fraud have often involved using related party transaction as the conduit. The trend of using related parties has prevailed over decades, with high-profile cases like Enron, Adelphia, Tyco, and the likes, creating concern among regulators and other market participants about the appropriate monitoring and auditing of these transactions. While RPT is not, there's no sin in RPTs, but the method in which it is monitored and audited, I think that's where we as auditors, we as controllers have a big part to play. The story in India has been similar, whether we have seen siphoning and mass-scale rigging of financial results using affiliated companies and controlled entities in many high-value frauds, whether in ILFS, Bhushan Steel, or India's Star Diamond, pun intended, Nirav Modi Group. This has left hapless investors and citizens to pay for the bank losses, wondering as to which gatekeeper failed in its oversight. Wondering as to which gatekeeper failed in its oversight. And we as gatekeepers have a humongous role to play to ensure that these RPTs are regulated appropriately. In recent years, the increase in the number, complexity, and pervasiveness of reported frauds, including those reported by the banking companies, which I'm sure Himanshu will talk a lot about, and Suresh as well, have led to the financial community posing the questions. Are there some transactions which are more likely to be vehicles of fraud? Can those be detected early? I think the trick is in detecting these early. Global research by academia and regulators veer towards the fact that transactions routed through parties that are related, controlled, or influenced by owners and management, irrespective of there being any common ownership or not, are the key conduits for perpetuating financial fraud. This relationship leads to illusion, opacity, and complexity, which is difficult to disentangle and segregate as fraudulent transactions till it is too late. However, in most cases, the frauds are detected by chance or by admission of the perpetrators themselves when they have no means left to continue to cover up. Our Companies Act 2013 defines a related party. It's a long, big paragraph which talks about relationships, which I really don't want to talk about. Suffice to say that this pervasive and detailed definition brings into purview any legal person whose dealings with the company in question are subject to further scrutiny. Quickly talking about some of the research findings on RPT, the research into fraud mechanisms show an increasing use of related party transactions by company. The common types being purchase or sale of goods or services from related parties, in which payment was made, but the purchase was either undisclosed, unapproved, or non-existent. The next two most frequently occurring type of RPT was lending or investments, that is, extending loans or investments that were improperly disclosed and or improperly valued to related companies and to executives. In India, the trend seems to be moving in a similar direction. If I have to talk about fake transactions, the research paper further found that fake transactions and records account for a good percentage of reported instances of sample frauds by value, and manipulation of the financial statement was the vehicle through which this was mainly perpetrated. However, it is essential to note that this is mainly applicable to non-disclosed related party transactions, since related party transactions are a lawful practice. There's nothing wrong in related party transactions. The related party transactions are a lawful practice and legitimate activities that serve practical purposes recognized both in corporate and taxation laws, however, with their own standards for accounting treatment, with specific systems of checks and balances built around them to make sure that they are conducted within the boundaries of the law. Whether it is manufacturing or financial services, related party transactions happen even in trusts, okay? And if you see the FCRA regulations, there are so many regulations to ensure that, these trusts also do not receive money and from related parties, and there is no, routing of funds which come into the trust. Last but not the least, there are a few risks and common issues which I'm sure the panel members will be talking about. Risks associated with RPTs include undisclosed related parties, the PUFE transactions, preferential, undervalued, fraudulent, extortionate, misclassification, and inadequate monitoring. Collusion among related parties can lead to severe regulation repercussions, necessitating a robust framework for its oversight. Common issues include the circumvention of approval mechanism, lack of transparency in pricing, the most important one, lack of transparency in pricing, and potential laundering of funds. Forensic reviews focus on assessing the legitimacy of RPTs and ensuring compliance with disclosure requirements. Recommended strategies include comprehensive compliance reviews, ongoing monitoring, arm's length benchmarking, important arm's length benchmarking, and advanced detection methods like data analytics and field verification. In conclusion, effective governance of RPT is crucial for maintaining stakeholder trust and ensuring compliance with regulatory standards. I end my short talk by this one line by saying related party is not a bad term, but is perceived as such. I think it's just the conflict of interest aspect that should be dealt with carefully and hence needs to be regulated. I think it's just the conflict of interest aspect that should be dealt with carefully and hence needs to be regulated. Thank you. Back to you, JHS.
Thank you, Satish sir, for your opening remarks and the keynote address. You've enlightened all of us on the positive sides of related party transactions, opportunities for better disclosures, and the way we can look at it in a more positive manner than the negative connotation surrounding the subject of related party transactions. And very grateful to you for also enlightening us on the red flags and highlighting, the potential negatives of the related party transactions regime. So I think this is a very good ground for all the panelists to start their deliberation, and without much ado, I will quickly now introduce all the stalwarts on the panel today, starting with Mr. Suresh Narayan. Uh, Suresh is a commerce graduate from Mumbai University and a fellow member of the Institute of Cost Accountants of India, holding a certificate of practice. He brings over 30 years of corporate and teaching experience across various institutions in the corporate sector. He has led leadership positions with domestic capital market institutions such as Shell, NSDL, NSC, and NSC's group companies, including NSC Indices and NSC Data and Analytics. He played a pivotal role in establishing the index licensing and market data business and driving its globalization. He has also held senior roles in multinational banks like JP Morgan, Northern Trust, focusing on global payments and operational risk. Suresh has been a speaker at numerous national and international conferences on capital markets. In academia, he has been associated with leading institutions such as NMIMS, ITM, SVIMS as a full-time visiting faculty member. His contributions extend to advisory roles, including membership on the Index Advisory Committee of the Multi-Commodity Exchange since 2019. Currently, Suresh serves as an adjunct faculty at NISM and as an independent non-executive director on the board of Angel One Asset Management Company. His extensive experience in both corporate and academic sectors positions him as a thought leader in capital markets and financial services. Welcome, Mr. Suresh Narayan, and a pleasure to have you with us today.
Thank you, Josefa, for the kind words of introduction. I think both you and Satish, as star openers of this power play, you all have really scored, taken the average to over 100 in the first 5 overs. And as middle order batsmen, we are probably going to find it a little difficult to maintain the tempo. We'll try and do that, and we are going to have a spinner who's going to come and bowl googlies and flippers at us. That's Deepika, for those who don't know what I'm referring to. So, and the pitch is not a patia wicket as we call in Mumbai parlance. The wicket is spinning a little bit. The Asia Cup is on. We'll try to read her flippers and googlies as well as possible. I've already had a side conversation with Deepika. We're all talking about law, corporate governance, and ethics. So I was a little worried, honestly, when I came to know that Deepika is the moderator, because she's known for bowling googlies and flippers. So I used, having learned a little bit of law in early on in life, I remembered the Contract Act and the concept of undue influence. So I requested Deepika, if she could bowl some simple, overpitched balls which we can play, and she was a little hesitant. So then I had to remind her that I knew Josefa for over 20 years, and also reminded her that her half-yearly appraisal is due in the first week of October with Josefa. So hopefully, with all that that I told her about half an hour back, we'll get some overpitch deliveries, read simple questions. So thanks, Josefa, again. It's a privilege to be here on this esteemed panel. And as I said, both you and Satish in the power play have really scored so many runs. It's going to be difficult. I'm reminded of Chris Gayle and Tendulkar. What else can I say about you and Satish? So and we poor middle order batsmen will have to maintain the tempo. We will see how it goes. I won't take much time. Over to you, Deepika and Josefa. And again, thank you. It's a privilege to be here with JSS for this session. Thank you.
So Suresh, the match starts only at 8, so we have a lot of time.
Great. So we're still doing match practice, Satish. Yeah, thanks. Josefa, would you like to introduce the other panelists, the other middle order batsmen?
Have we lost Josefa? Yeah, he's not on the panel.
1 second, let me check.
Yeah, he isn't there up there. I think you lost connection.
We're good to go. I'm calling the IT guy once again. Sorry for the inconvenience, boss.
But here.
But how will you share?
One second.
Deepika, you're on mute.
I think she's talking on the phone.
I was talking to my IT guy.
Josefa, are you with us? We are able to see you.
No, I think we lost them. The JHS office have you. They're back.
They're back.
Hello?
They're on mute.
Yeah, Deepika, complete your introduction.
There is an echo, Huzaifa. There is an echo. When you speak, there is an echo. Huzaifa, please say something.
No.
Or Himanshu, kuch to bolo.
Hello, sir, can you hear us?
Deepika can start. Deepika, you can start, please. Go ahead.
You would like to introduce other panelists?
All right. I have already introduced all the panelists. You want me to run through again?
We only heard Suresh's introduction.
Okay,
Yeah.
okay. Let me just reintroduce everybody. I'm sorry about this. Some technical glitches at our end. So let me welcome Mr. Himanshu Vasa on the panel. And Himanshu is an independent director at ASK Trustee Private Limited with over 34 years of leadership experience in banking, financial services and consulting, a chartered accountant, a Wharton alumnus, certified fraud examiner, and certified control assessor. He is widely recognized for his expertise in corporate governance, regulatory compliance, enterprise risk management, and strategic transformation. He has been honored with the CFO 100 certificate of recognition for 7 consecutive years for his contribution to the finance and compliance domain. He spent 2 decades at Kotak Mahindra Bank, where he served as President and Chief Compliance Officer and Principal Officer under PMLA. As part of Kotak's core leadership team, he drove regulatory compliance, risk management, automation of governance processes, integration of ING Vesya Bank, and oversight of major internal audits and fraud investigations. Earlier to Kotak Bank, Himanshu had a stint with KPMG India. He specialized in risk advisory, statutory audits, capital markets, leading several critical investigations. He began his career in 1989 by establishing and managing a stock brokerage firm and practicing as a chartered accountant, advising listed and private clients. Over the years, he has become a sought-after voice at industry forums, admired for his integrity, insight, and ability to navigate complex regulatory and operational challenges with strategic clarity. We have the privilege of having Himanshu at our office today at the JHS conference room. A very warm welcome to you, Himanshu. And I'll move on to the next speaker's introduction, Tasnim Tankiwala, who's a partner with JHS. Tasnim carries over 2 decades of solid assurance and IFRS experience under her belt. Prior to JHS, she was a technical director at Sudip K. Parekh, and Tasnim also is a DISA insurance and an insolvency professional. She's JHS's champion partner as far as IFRS, Ind-AS, and regulatory disclosure related opinions, technical assignments, and statutory audits are concerned. With this, a very warm welcome to you as well, Tasnim, on this panel. And a warm welcome to all the panelists, and really sorry about the technical glitches. And with this, I'll hand over to Deepika to start the moderation.
Thank you. Thank you so much, sir, for laying out the foundation and the background for introducing our distinguished panelists. As we all know, related party transactions are no longer a technical disclosure exercise. They are now critical to conversation on the board oversight, audit responsibility, and the regulatory accountability. With the SEBI's recent amendments, the enhanced security, we are what they call it as we are into the RPT 2.0 era, as they call it. And today's panel is perfectly placed to unpack what it really means in the corporate, Indian corporates. So my first, to begin with, I would like to ask all the panelists, how do you define the importance of transparency and control in related party transactions within today's corporate governance landscape? Suresh sir, would you like to take the lead?
Yeah. Thanks, Deepika. And I believe the heads up works, so it's relatively a simpler question to answer. And thanks for allowing me to speak first.
I'm trying my level best.
Yeah, thanks. RPT, when we look at it from a materiality perspective, you spoke about transparency and control. Let me go a little further and add the word objectivity to it. So we're talking of transparency, we're talking of control, but these two to me don't make much sense unless there is objectivity to it, and that to me is the third piece of what we call the trikon. And in Hindi there's an old saying, trikon ka chautha kon. So again, these three are not effective to me unless there is proper execution of all these. And we often find that regulations are there, but as they call in the IT world, the last mile connectivity. So the execution, I'm sure as a country, that we can do much better. We've had amendments over the last few years, and Satish spoke about it elaborately, going back 25 years, how far we have come. But when it comes to execution, my own personal view is that as a country we can probably do much better. When we talk of RPT, the obvious expectation is that transactions are conducted fairly, ethically, and in the best interests of the minority shareholders. From a regulatory perspective, obviously the regulator wants to see that everything is hunky-dory, but then somewhere in between you have ILFS popping its head up. You had Satyam earlier. Satyam, by the way, was on a Thursday evening the winner of the Golden Peacock Award for Corporate Governance, and next day morning Ramalinga Raju applied glycerin to his eyes and came in front of camera and said, "Sorry, I betrayed you all." Closer home, DHFL, willful default. You have the money, you don't want to pay, you siphon off. We had Blue Smart, again an example. So lots happening there, and it's I again like to compare it with we have a lot of Gen Z on this call, I believe. So to me this is a little bit like the dark pool. Beyond the point that the IP address gets masked, so you really don't know what's happening there, and time probably to kind of get into the dark pool and see what's happening and unravel the mysteries that are there. Companies do this, again, use sophisticated terms like transfer pricing, but we all know how they juggle the books and come out. From a control perspective, I believe had the opportunity to work in JP Morgan in operational controls, but my own sense is preventive controls probably will do better than detective control. It's otherwise like crime patrol that we see on TV. where ACP Pradyuman comes in after the crime has been committed, and you really can't do much. If anything has to happen, it has to happen before the fraud gets committed. And we again, sorry to put down Indians, but when it comes, I'll give the devil his due. But we are famous for jugaad, right? The jugaad word is quite common in Shashi Tharoor's language. We call it asset tunneling. Okay, and that's how the diversion takes place. At the same time, as companies, the promoters want to project a poster boy image that look, it's not as bad as you think, so they come up with brand ambassadors. To me, ideally, this is RPT. Since we talked about transparency and control from a governance perspective, I link it to ESG, environment, social, and governance. So the G part to me is very important, not to belittle environment and social. And interestingly, if you look at the ESG index, incidentally, I was involved in creating the country's first ESG index. By and large, it is believed that companies which do well on governance, it is reflected in the share price of the company. So just to give you some numbers, the 5-year ESG index has delivered about 18.5% returns. And this is across large, mid, and small cap. The 5-year Nifty has delivered around 20%. So whether it's large, mid, or small, the thumb rule is that shareholders are or the market is not really foolish, and they believe the data. And so yeah, I'll stop there and allow
transparency bill. Now, just to bring in some value context, if one looks at a little dated SEBI report, okay, I think it is of sometime around 22-23, where about 15 to 18% of the total transactions of the Nifty 500 companies are related party transactions. And if I was to translate that in value terms, about 2,500 companies constitute about 16 trillion rupees of transactions. 16. While we may say 15 to 18% is not very significant, sheer volume 16 trillion, and this is both on the balance sheet and P&L side. I must also mention that while there is a increase in the balance sheet size and increase in the profit and loss side, the sheer percentage of the balance sheet and the profit and loss over a period of time, the related party transactions are not or have significantly reduced, and the reduction is coming on two counts. One is ease of regulations and increase in transparency. So, to put things in perspective, again, lot has happened since in the last 2 decades, and more is happening. The other most important thing to remember is that RPT is one of the most worried area for a CFO. Okay. Again, a survey done by one of the big fours, RPT related compliance risk was noted by more than 50% of the compliance officers, more than 50%. And that's a huge number. And that predominantly is coming not only from a reporting standpoint, but also from a identification first. And some of the regulatory requirements as we go along, you will see are precarious and are really deep down, which it also kind of includes something which includes like a transaction with a unrelated party, but benefits are derived by a related party, not only of the entity, but all its subsidiaries. Now, uh, it's a very, very precarious situation. And let me give you an example of explaining why, because why it is so critical. Think about a bank having a subsidiary where it is doing lending of motor cars. A third subsidiary director comes and takes a loan at regular interest rates from an NBFC, which is also a subsidiary, and that transaction to be disclosed and judgment to be made whether the director has received any undue benefits. I mean, this is the kind of complication, and I can continue to give you examples after examples. Suffice to say that this example should help us determine the importance and why it is such a high compliance risk for the regulated entities. Over to you, Deepika.
Thank you, Himanshu sir. The numbers you have shared are really, I mean, it just blew my mind looking at those 16 trillion transactions and all. Tasneem ma'am, would you like to add something to it?
Yeah, thank you, Deepika. First of all, I'm really honored to be here today alongside such eminent speaker. I extend my heartfelt thanks to the JHS family for giving me this opportunity to speak on a topic that is both technically significant and practically relevant. So I start with a simple question. What do corporate like Satyam, Enroll, Enron, ILFS, and DHFL have in common? Well, according to me, all of them were brought down by one critical area that we are here to discuss today, and that is related party transactions. So I am going to deal with the multi-regulation part, which governs the related party transaction. So when we talk about Satyam, Enron, ILFS, and DHFL, they weren't just corporate failures. They were wake-up calls that actually shattered the investor confidence, and they reminded us why RPTs have become the most scrutinized area in corporate governance today. Further, what makes RPT particularly challenging for us? So we are dealing with not one, not two, but three different regulatory frameworks. That is the Companies Act, the SEBI LODR, and the accounting standards. So each one deals with a different aspect of the RPT. Like the Companies Act tells us how to get approvals. SEBI LODR focuses on what we must disclose to the market, and the Indian accounting standard dictate that how do we report this transaction in our financial statements. So a different regulation, different perspective, but the same goal. That is to protect the stakeholder, especially the minority shareholders, ensure transparency and enhance credibility of the financial statement. And believe me, just when we think that we have mastered the rule, they evolve further. That is proved by SEBI recently introduced RPTs industry standard, which are applicable for all the listed companies effective 1st September 2025. So this standard isn't just another compliance requirement. It's a clear signal actually that the regulators are constantly strengthening the framework based on what they have learned from the past failures. So where does all this leave us as audit professionals? Whether we are on the audit committee or we are a statutory auditor, our job has fundamentally changed actually. We are not just compliance checkers anymore. We are the guardians of the market integrity. So every related party transaction we review, every disclosure we examine, every approval process we oversee, these aren't just audit procedure. They are to rebuild the trust that scandals like ILFS, DHFL, Enron, Satyam has already damaged. The question before us today isn't whether RPTs are important. Recent history has already answered that. The question is, Are we equipped to handle this responsibility? Do we understand the nuances of this multiple regulation? And most importantly, are we implementing them in spirit and not just in letter? Yes, Deepika. So that's my opening remarks. Thank
Very
you.
nicely put, Tasnim. Very, very nicely.
Thank you, sir. Thank you.
Very. All the panelists have put their perspective in a great way. Great learning for all of us who are available here. And it's a actually reminder that transparency and trust are the cornerstone of responsible governance. In the interest of time, I'll move on to the next question. Let's begin with the ground level view. Himanshu sir, from your vantage point, working closely with the compliance functions, I would like to ask, what are the top 3 risks and controls you have observed in a large organizations related to RPTs?
I think very interesting question. I think, what is RPT all about? RPT finally is all about identification. It is about having a baseline with which you can compare a related party transaction, and then the entire approval and the disclosure peripheral. Now, if these are the 3 big steps, these are the 3 big risks that I see at the ground level. Now, you see, with the new amendments that have happened during the year, it is not only the transaction of a listed entity which is counted as a related party transaction, but it is also the related party transactions of the subsidiaries which are related parties of the holdco. And of course, there are certain exemptions in terms of transactions between 2 subsidiaries inter se, or transactions between holdco and subsidiary, or payment of dividend, or fixed deposits in a bank, etc., etc. But there are a lot of interpretations that come through, given that the requirements are spread across A, the Companies Act, B, LODR requirements, and C, the accounting standards. I may just add that if finally it is going under the insolvency and bankruptcy, there is again a definition in that regulation also. Okay, and I'm sure there is a regulation which is appearing in Ind-AS also somewhere. While since I've been in a bank and Ind-AS has not kind of hit the banks as yet, I don't have practical experience of how it operates, but I'm sure some of my colleagues who have had the experience can talk about it. So these are the 3 big risks. Now, identification, you can bring method into the madness, have an extra vigilance. Besides the disclosures made, you have secondary disclosures. For example, let me give you a practical experience. As part of the related party transactions, if you are a director in any other if a director is a director in any other entity, or a relative of a director is a director in any other entity, all those things are also available in the public domain. So one has to do a secondary check. While a director would have exercised due caution, it is also the ownership of the regulated entity to ensure that there is a secondary check that is being done from a practical standpoint to ensure that the probability of an error is reduced. So that's point number 1. Point number 2, certain interpretations, and sometimes some of the transactions which require prior approval cannot be thought through also. Let me give you an example. A related party in a bank crossing accumulated transactions more than 10% of the company's turnover. Now, if the consolidated number, and as it stands today, the number highest is 1,000 crore of rupees. Now, if the sum total of all the credits into the bank account are in excess of 1,000 crore of rupees, A, you have to take prior approval of the audit committee, and B, you have to take shareholders approval. Now, I will never, as a regulated entity or a reporting entity, think about which related party will have transactions above those cutoff limits, because you have to go to the shareholder. So that is a risk from a reporting entity or a regulated entity perspective. So some of these things management will have to anticipate, or management will have to take some data of 3-5 years of the historical data and make sure that proper omnibus approvals are taken from a identification and a reporting perspective. Now coming to what is finally RPT? RPT means that a transaction with a related party is happening at an arm's length. And how do you define arm's length? Arm's length is nothing but if the transaction were between two independent set of people, the pricing at which the transaction would have happened does not get impacted between the two independent entities. Now, if any one of the parties is a related party, then you will have to do an arm's length testing. And how does one do an arm's length testing? Trying to find out if such a similar transaction has happened with somebody else who is not a related party, and can you do a comparison of all of that? And of course, the disclosure is picking up from the books of accounts, making sure that you do a secondary check through your financial records and systems, etc., etc. Having said all of that, I think one of the most underrated or the least often picked up risk is the documentation risk of having ensured that the pricing and valuation has been done in an appropriate manner. And what do I mean? If there is a transaction with a related party, a similar transaction you would have verified, but have you documented that? Have you got a supporting proof, or have you got supporting evidence to demonstrate at a future date that you have taken care of what you were supposed to be doing, and therefore a transaction given is a transaction at an arm's length. So these are some of the risks which come to me top of the mind, which one should be worried about.
Thank you, sir. That's like a practical checklist, and that many of us available here in the audience will be able to relate to it. Moving on to the boardroom lens, Suresh sir, as someone who has seen governance practices evolve over the time, do you believe India has now emerged as a global benchmark for governance and disclosure practices in RPT?
Okay, thanks, Deepika. I would like to err on the side of caution. And I've always been known to be conservative, critical, cynical, and I'll prefer to continue that stance of mine. And I see Satish smiling there. So, but let's go back. And honestly, we aren't all that bad as we call ourselves. The potholes in Mumbai are there. Fine. It took me 3.5 hours yesterday to come down from Parel to Thane. That's fine. The metro is on. It probably won't go live till the 2029 elections. That's fine. But on a more serious note, I think if we look at capital market as a whole, we aren't as bad as we think we are. So let me start with the positive side and then move to the other way. Stepping a little away from regulations and governance, we implemented T+1 in the securities market, something the US was struggling. We went live in 2023. The US gave it a fancy name. Probably they consulted Shashi Tharoor for that. They called it T2S, Target to Settlement. They introduced in 2024. Inside news is that they're still struggling 1 year down the line. So there have been places where India has been ahead of its counterparts. 1996, when DMAT was introduced, perhaps no country in the world adapted to DMAT at the speed and pace at which India did. The Gen Z population here today probably doesn't know what it was in the pre-DMAT era to deal with physical transfer and settlement. And once the tiger tasted blood, as they say, ye dil mange more. So we went all the way, and today we're talking of T+0. We are talking of instantaneous settlement. Chat mangni pat bya, 30 minutes. You buy and you pay and you get shares into your account. Is it possible? Yes, it is. The banking has got upgraded. So yeah, we are there. But coming back, when it comes to RPT, okay, there are various phrases that the gurus give, from good to great. So we are good. Are we great? Not really, in my view. Okay, there's again a famous saying: "What gets you here won't get you there." So we are here right now. Still a long way to go to get there, in my view. Okay, let me divert a little bit from the question. I happened to read and go through Huzaifa's presentation that he had made a few days back, and on RPTs, he had aptly titled it, "Is RPT a risk or an opportunity?" And now somebody might wonder, this is an out of syllabus question. Why are you bringing it to the topic or the question that Deepika asked? To me, it's relevant because here we are presented, as I said, we are not there yet. So I see it as an opportunity that we can look at to get there. We have Gen Z here. I keep reminding myself, and to give you an unrelated but something that they will relate. As a parent, I'm today worried about Discord. The Gen Z will know what is Discord. Parents, if you don't, please read up on Discord. Okay, there are two sides to Discord. Okay, Instagram is pass. Okay, Facebook is gone. Twitter is gone. The Gen Z is on Discord. The Bangladesh coup, the Nepal coup, sorry, was planted or was in the dark web through Discord. Now, how do you look at Discord? On the positive side, you ask Gen Z, they see it as an opportunity. If I have to use Huzaifa's jargon, as a parent, I look at it as a risk. So, the same thing, people view things differently. To go back to our generation, again, philosophy, the glass, is it half full, is it half empty? In Hindi, you used to have a famous dialogue, Laila ko dekho to Majnu ki nazar se. So it's how do you see that particular thing? And so how do you see India? To your question, coming back, is it a global benchmark? And let me add Satish's favorite topic, which is cricket. For me, there are only 4 great batsmen in the history of cricket: Sir Donald Bradman, Sir Isaac Vivian Alexander Richards, my childhood hero, Brian Lara, Sachin Tendulkar. And I know there are a lot of Virat Kohli fans here who will probably beat me up. I'm happy it's a virtual one. I'll have to come with bouncers next time I go outside. Was Virat Kohli good? Yes. Was he great? Probably not. He needs to get there. He's already retired. Okay, and why was it? Because, and I said that to a session I took in the morning. He knew what to do, but he probably did not know what not to do. That was poking outside the off stump. Okay, again, very relevant. You can draw parallels to the boardroom and to RPT. Okay, you should know what to do. You should also know what not to do so that it doesn't come under the ambit of RPT. Okay, so we still lag behind. My personal view, as I said, I'm cynical. I'm an independent director. Err on the side of caution. We are still, my own sense is lagging behind in enforcement. Like the Indian cricket team, we are paper tigers. Good on paper. When it comes to beating teams, winning the Asia Cup is easy. Okay, consistently, do we beat in test matches? Do we beat in one day? Okay, execution still, as I call the last mile connectivity. We are a maturing market. Are we a matured market? Not yet. Enforcement needs to be strengthened. Having said that, due credit to the regulator, the intent is there. So, we talked about SEBI's amendments 2021 to 2025. We have experts there. Tasnim is there. She'll speak more on that. Okay, we have the Ind-AS. We're trying to align it with IFRS. Not my area really. I'll leave it to the experts to speak on that. But thankfully we are not like Sri Lanka. I was in Sri Lanka helping them set up the index business. They said we are NATO, and my history and geography, I was wondering, when did Sri Lanka become a member of NATO? So in Sri Lanka, NATO means, they say, no action, talk only. We are thankfully not NATO. There is some action at our end, but we need to walk the talk, as they say, and do something. There are gaps and holes in enforcement and execution. Countries like UK, Singapore, and South Korea, there's lots to learn from them. And I believe we need to get there. So more than strong rules, we need strong and consistent execution. We need to walk the talk. If we don't, sooner or later, Arnab Goswami will come up and say, please answer, the nation wants to know. I'll stop here, Deepika.
True. That's an encouraging outlook for India to make the alignment with the global standards. It's a big leap forward actually for India. So now let's shift the gears and let's now bring the legal perspective. Tasneem ma'am, RPT definitions often create confusion. We have seen it amongst our clients many a times, especially across the regulations. We have accounting standards, we have Companies Act, and now these new industry standards. Can you briefly highlight the key differences between the Companies Act definition and accounting standard definitions? You're talking on mute.
I'm so sorry. Yeah. So thanks, Deepika. So to answer to your question, Deepika, I think so Suresh sir already mentioned about the tricone. So I would also agree with him and say that there is a tricone or a three-dimensional regulatory framework that is existing currently, which is Section 188 of the Companies Act, the SEBI LODR Regulation 23, and the Ind-AS 24, which is aligned to IFRS and currently operational operational in India. And all listed entities, even the bigger ones, are all under Ind-AS. So today, basically, I want to focus on the fundamental differences between the Companies Act and the Ind-AS. SEBI LODR is more or less the summation of two, the Companies Act and the Ind-AS. When we compare these two pieces of legislation, that is the Companies Act and the Ind-AS, there are certain striking differences. So I'll point out few which are really critical ones. And the first major difference lies in the fundamental philosophy. So the Companies Act 2013 takes a shareholding-based approach. It uses the bright line test. For instance, in public companies, directors or key managerial personnel become related party if they hold directly or indirectly 2% or more of the paid-up share capital. That is what the Companies Act says. So the threshold is 2% or more of the paid-up share capital. It's black and white, easy to measure, and leave little or no room for interpretation. It is well defined. Now, when we go to Ind-AS, it shifts the focus from shareholding to significant influence and control. So whenever we talk about Ind-AS, Ind-AS does not lay down any clear threshold. The test is always significant influence and direct or indirect control. It generally asks you a question. Does this party have the ability to influence the reporting entity decision? I mean, if your answer is yes, then the individual is a related party. If your answer is no, the individual is not a related party. So this approach is quite risky actually because it requires too much of a judgment and continuous assessment by the senior management, making it complex but arguably more comprehensive in capturing the economic reality of the relationships that we are talking about in the related party. So the first shift is from shareholding to influence and control. The second key difference is how the key KMP or the key managerial personnel are defined. So again, when we go to the Companies Act, the definition is position based and exhaustive. We are talking about few positions like the managing director, the whole-time director, manager, CEO, CFO, and the company secretary. So if you're holding any one of this position in a reporting entity, you are a KMP. There is no ambiguity, no further interpretation required, a watertight definition given by the Companies Act. Now, shifting our gear to Ind-AS 24, it takes a completely different approach. It defines KMP as anyone who has the authority and responsibility to plan, direct, and control the activities of the reporting entity. So, no position defined. The only thing is check the authority and responsibility given to your key employee. This means that your chief operating officer, your chief technology officer, your marketing or sales head could all be considered KMP if your answer is yes, that whether they have the authority and responsibility to direct, plan, and control the financial and operating policies. So again, Ind-AS leaves us with further, I would also like to point out that KMPs of the parent company are also treated as the related party for a subsidiary. So it extends further to the KMP of the parent entities also. So subsidiary has a dual burden of reporting their own KMP and KMP of the parent and the ultimate holding company. So this definition again requires management to continuously assess who truly has the decision-making authority in the organization. So it's a continuous assessment. Now there are also differences between the disclosure requirement of the KMP remuneration. The Companies Act demands individual transparency. That is, you have to state the name of the KMP, the specific remuneration, the previous year figures. So in the director report, the management is required to give the entire disclosure, individual wise, each KMP with the position, with the name, etc. However, Ind-AS allows you aggregated disclosure. So you can simply state the total remuneration paid to all the KMPs without naming any position, without naming any individual. The only thing you must disclose under Ind-AS is that the number of KMPs is that 10, 12, 15, 20, whatever be the number, just disclose that KMP remuneration 20 numbers and then disclose the remuneration. Again, Ind-AS breaks down the remuneration into 5 different categories. That is the short-term employee benefits, the post-employment benefit, the long-term employee benefits, severance benefits, and share-based payment made to the employees. So all your disclosure should be categorized in one of this bucket and should be presented in the financial statement. So after discussing the KMP and the remuneration of the KMP, let's move forward with the definition of the term relative. Again, section 2, subsection 76 of the Companies Act is crystal clear. It defines relative based mainly on blood ties or marital relationships. So members of the HUF, spouse, parents, children, sibling, and their spouses. It's again a closed list with no room for interpretation. Ind-AS 24 introduces the concept called close relative, again based on influence control. The standard asks you, can this relative influence the individual or can the individual be influenced by that relative? So if your answer is yes, again, he is a relative. Whether he is a close relative, he is a distant cousin of yours, doesn't matter. So you always have to answer one question based on influence and control. Further, Ind-AS also gives recognition to somebody called as domestic partner or live-in relationships. So the domestic partner is considered to be a relative and he or she is to be reported in the related party disclosures. So this again gives management continuous assessment exercise. The management needs to be aware about family dynamics, about the influence pattern, which is not easy. It's not very easy to get details of an individual and his close and distant relations. So it's a tough job for the management. And it makes Ind-AS more complex, requiring an ongoing evaluation. So after the definition of relative, I would like to highlight two unique aspects of Ind-AS 24. Firstly, it includes some special purpose vehicle, like the employee benefit plan, as a related party. So the gratuity plan, the pension funds, the provident fund schemes are all related party when they benefit employees of the reporting entity or employees of any other group entity which are related to the reporting entity. And detailed disclosure with regards to contribution made to this plan, investment made by this plan, return on investment on by the plans, all required to be given under Ind-AS 24. Unfortunately, nothing of this sort is covered under the Companies Act. The Companies Act does not address this criteria. Second, Ind-AS 24 provides relief to government-related entity. So public sector enterprises, as per Ind-AS, can aggregate similar transactions with government departments or other public sector undertakings, rather than disclosing each relationship individually. However, the aggregation option will not be available in case the transactions are significant or they are not in the ordinary course of business. So we have dealt with the key differences, which include shift from shareholding, definition of KMP, disclosure of remuneration of the KMP under 5 different heads, definition of relative to include the domestic partners and distant relatives in case they exercise influence, inclusion of special purpose vehicle like employee benefit plan, and exemption given to the public sector undertakings. So these are the key differences between the two regulations. And I would like to conclude with that the Companies Act 2013 is compliance driven, using bright line rules to ensure regulatory adherences. Ind-AS 24 is transparency focused, using principle based approaches to ensure investor gets a true picture of economic relationship. Both are essential, both serve different purposes, and both require a robust system to manage the dual and sometimes even the conflicting requirements. So the only thing we could wish for is that there is harmonization. The harmonization between this tricone or this tri-dimensional regulatory framework. The challenge for us is to build identification processes and disclosure system that satisfy both the philosophies, the regulatory precision and the economic transparency. So that is something we look forward to. Yes, Deepika.
Thank you, ma'am, for the valuable insights. While framework may strengthen, governance culture still plays a key role. It's really important to have a check on the governance which is happening in the company. The policy, the checklist are still important to have the important governance. We have received few questions in the chat box.
Few of the questions which have come, she has answered. In fact, few of the questions which have come in. But anyway, Deepika,
Yes.
you go ahead.
Yes, sir. Okay. We have received few questions in the chat box, so I'll read it out. Whether an employee welfare trust or trust formed by the entity will fall under the definition of related party as per Companies Act, SEBI LODR, income tax index. What would you be the key defining point? This is for Tasnim ma'am.
Yeah, so I think so I already answered that question.
This
Deepika.
question, yes.
Yeah.
So
while it will not be a related party under the Companies Act because the special purpose vehicles are not included, it would form a related party under SEBI LODR and as per the accounting standards. So employee benefit plans are specifically included.
Yeah. Next question is from Dhruv Sharma. How can boards ensure transparency in RPTs without overburdening the management? So Himanshu sir, would you like to take this one? Or
I think there is
maybe
no
Suresh?
choice. I think there is no choice. If there is a reporting requirement, it needs to get reported. There is no it's a simple black and white. There are no shades of gray.
Correct. So
What is required to be reported is required to be reported. The good part is that, if you are a listed entity, you have to do it once every 6 months. However, if you are not a listed entity, it's only a part of your financial statements.
Sure.
So, and the intensity of disclosure is higher for the listed entities, and I'm sure there are enough control measures and bandwidth available. And if it's not there, it's built up to ensure that you are meeting the regulatory requirements.
So I'll just add to what Himanshu mentioned from our past practical experiences is that, the burden is already given by the regulator on 1st of September. It's an 80-point checklist. And it's so detailed that it expects a reply from the first line of defense and then validated by the auditors, validated by the audit committee. There are 3 columns in that. So the burden has already been placed. Now it's up to the industry and to the audit fraternity to come out with systems, processes, policies, alignment, training, skilling, manpower. And to add to all of that, key regulators such as NAFRA have come out with a series on related party matters and transactions and given a checklist of 30 to 40 key questions which the audit committees are supposed to ask the auditors annually. And if you go through that, there is a burden on compliance, there is a burden on accountants, there is a burden on each and every management function of the organization. So I would say that at least for a year or two, we have to carry the heavy weight on our shoulders.
If I can just step in
Suffice to say that, just 2 days ago, SEBI has kind of expressed it in intention to come out with scale-based material transaction definition requirements, which will hopefully ease a lot of disclosure requirements for a lot of entities.
Great.
Yeah. Let me just add in here and play the devil's advocate. Notwithstanding what Josefa and Himanshu said, but while data says that 60% of Indian listed companies are group-led business models, and Josefa was wearing his auditor hat and saying that, look, 80-point checklist and companies are will be required. Auditor has to go and tick in the box. I come back to the Indian jugaad. Never underestimate the Indian jugaad. And will this all this from 2021 to 25, is it going to increase or decrease RPTs or greater scrutiny? Indians are smart, right? So there will always be a way to escape whatever has come out as regulations. If there is a threshold defined, we all know if there is a 50,000 limit for cash transaction, you will deposit 49,000 in the bank. Okay, so there are people are going to find smarter ways of beating the rules and still getting away without it being called RPT. And let's accept it. RPT is a necessary evil. I don't want to use the word evil. It's probably not the right 4-letter word as we call it. Okay, but given that 60% of the units are promoter held, they need it. You need a wicketkeeper in the team to play a match. You can't do without a wicketkeeper. You may have the best of bowlers, best of batsmen. RPT is something that, and I'm conscious, I'm wearing the hat of an independent director also, but this is something that we have to learn to live with, like the potholes of Mumbai, like the pollution of Mumbai. like it or not, we have. So all we can do is, how do we ensure that there, in spite of all this, how is transparency going to be there? How is arm's length going to be maintained? I think we need to look at all this and pardon me, all the chartered accountants on the call. I know you'll have a majority here, but I think we'll have to probably look beyond the checklist to say, with all these additional regulations, let's not look at the complexities of the checklist. Let's focus on the materiality aspect and see how we can still ensure that there is adequate governance over RPTs. Sorry for butting in there, Deepika.
Yeah, Suresh sir, maybe you can take the next one, the last one, which is why regulatory authorities allow RPTs in public and listed companies. Is it so necessary in the interest of stakeholders and the company as a whole?
I thought I just spoke about it. So as I said, let me go back and turn the page. As I said, structurally, call it a necessary evil. 60% of entities are promoter held, and let me quote. So as part of the preparation, and let me confess, having listened to Deepika as a moderator in the past, I was scared. So I have spent a lot of sleepless nights going through lots of reading material. The googly and the flipper coming in, I was a little worried. So let me read out and say, and I concur with what. RPTs are essential, in my view, for all companies for operational efficiency. They are necessary for supply chain integration. They are necessary for shared services. All group companies operate on the shared services. The benefits of shared services, everyone know, and for capital allocation as well. Okay, I personally believe that rather and let's remember one thing: over regulation is not the be all and end all solution for everything in life. And let me quote an example from my so to say forte, and move a little, digress a little. We had speculation in agricultural commodities, and people thought that banning derivative contracts in those agri commodities is going to curb speculation. 7 products, derivative contracts were banned. Did speculation stop? No, it continued unabated. So very often, excessive or over regulation may not really be the solution we are looking at. I think we need to have a balance. Now, where do we draw that line of the risk of under regulation? So we call ourselves over regulated. Remember 2008 crisis, we were largely decoupled. The whole world crumbled, India was still stable at that time. Now if you ask the broking community or the capital markets community, they say the regulator is over regulating us. We find it difficult to survive. But hey, the risks are of the scams that happen are far less than what happens globally. Do they not happen at all? No, they do. The best of IS security, Huzaifa will tell you, the best of things you build, there'll still be a hacker in Israel who will probably still beat that and get in. So how do we draw that line? And then coming back to cricket, something that Satish didn't get time in his 10 minutes, let me come back to cricket. Is the call that you have to take on the 4th day, the 3rd innings. Okay, when do you declare and what target do you set? A total of 590 overs. Okay, and you want to take the last 10 overs to bowl and try and get 1 or 2 wickets. Okay, the captain is always under pressure. He declares late. They say you didn't have confidence in your bowlers. You should have given him 5 overs in the end to try and take a wicket or 2. So where do you draw that line between over regulation, under regulation? Is a matter of judgment. I hope I've answered that question, Deepika.
Suresh,
Yes,
the time
yes.
of the declaration is done. All these comments are made after the match, not while the decision is to be made.
I agree, Satish, and remember, I keep joking, and this comes out in things also. Typically, say you have 100,000 economists in the country. before and after the budget day, you typically
Yeah,
have
yeah,
500,000 economists.
yeah,
So
absolutely.
the same way, even in a cricket match, as you said, there are always people who will question the decision that a declaration was far too soon or far too late.
So, sir, Suresh, sir, on the lighter side, Deepika, time for our declaration has already gone
Yes,
past. We are
yes.
at
I
6:30.
was coming to that.
Such
Thank
a
you,
very
thank you
interesting
again,
conversation.
all the panelists for such a rich and practical discussion. With this, I would like to hand over the mic to my colleague, Mr. Jamal Chhatriwala, for vote of thanks.
Okay, good evening, everyone, and thanks for joining us today. First, a special thanks to Mr. Himanshu for setting the tone and introduction, and to Mr. Satish Shenoy for his keynote. And he explained beautifully to us the positive side of the RPT and the key concerns. He highlighted the entire concern in two parts. One is the conflict of interest in RPT and proper disclosure of RPTs. And also, we truly thank our panelists, Tasnim Tankiwala, Mr. Suresh Narayan, Mr. Satish Shenoy, for sharing their perspective and real life scenarios, and also the key risk associated with the RPTs. And thanks to our audience for participation and thoughtful questions. And we hope that you feel more ready to handle the RPT transactions in future. Let's continue to learn. And again, thanks a lot for joining us today.
We
Thank
missed
you.
to thank Himanshu. I think we need to thank
Himanshu.
Himanshu as well. Yeah.
He repeated, pun intended, my name. Don't worry. He meant you.
I got the message, Satish, very clearly.
So a warm thanks again to all the panelists and Satish sir, especially Himanshu. Thanks for visiting our office here. Being here in person, it means a lot. And Suresh sir, taking out time from your busy travels. I know you had a hectic day today in the morning and the lecture, and you continue to be so humorous as well. Something to learn from you always. And Tasneem, as always, your technical insights are great, excellent. Thank you everybody for joining.